As an owner of business, you want to know how much sales can be made from borrowed money and from own invested funds. Sales, operations, and finance are three key elements which drives the business. To know DuPont analysis, let's go to whiteboard. We know return on equity is how much dollar generated by firm for each dollar of equity. DuPont analysis is a useful technique to drill down the different drivers of return on equity, ROE. Drilling down ROE allows investors to focus on key metrics of financial performance and how each element is contributing towards return on equity. Net profit margin is how much percent of revenue converted to profit. Asset turnover is how effectively assets are used to generate revenue. Financial leverage is how much the company borrow to leverage. For a firm, return on equity can be increased or decreased by changing one of these three parameters. Return on equity can be higher for a company over other due to better product value proposition giving higher profit margin, or company is more efficient in utilizing the assets, or company has good credit rating. Combined profit margin ratio and assets turnover is a measure of productivity or return on assets. By doing R&D, if you increase product value which gives higher margins while other parameter remains, return on equity increases. You exactly doubled your sales by selling online. Return on equity changes. You increased your credibility and got 50% of equity converted to debt. Return on equity changes. DuPont equation developed in 1914 by a DuPont explosive salesman named Donaldson Brown. He later used it as CFO at General Motors. In modern accounting, the DuPont equation is further drilled down to calculate the tax burden, interest burden, and operating margin. Let's take the example of the Procter & Gamble Company (PG) income statement and balance sheet to evaluate what is driving the ROE over the years. From the calculation, it is clearly visible that for Procter & Gamble last 3-year ROE is decreasing. In 2018 mainly due to tax burden, and in 2019 due to interest burden. While operating margin, asset turnover, and leverage more or less remain same. Similarly, DuPont equation can also be used to analyze the return on equity for two different companies.